recently a reader asked me, is there anything more that we could be doing to get out of a recession? Um, and the answer really is not very much. It would take, first of all, fiscal policy. Um, the government has definitely pursued expansionary fiscal policy with the recent budget. Government borrowing this year is proposed to be approximately 110, 115 billion, which I believe is about 8 or 9% of GDP. Now that's a pretty big figure. It's a very big fiscal expansion. It involves tax cuts and higher spending, and also the just the automatic effect of the recession. The government have to spend more on unemployment benefits and receive less tax, especially lower tax from the financial services. So the government has cut VAT and increased spending, and I think it's difficult to borrow more because the national debt, the public sector debt, isn't too bad. It's 47% of GDP, but if there was an even bigger deficit this year, I think the markets would start to worry. People would be reluctant to buy the debt, especially from overseas, and this decline in confidence would be damaging. Secondly, we've got monetary policy. Well, the Bank of England have done as much as they can. They've cut interest rates very quickly since they realised the economy was doing very badly. I mean, you could argue they were rather slow to cut rates, but since the summer, rates have come down very quickly from 5% to 1%. And the problem with cutting interest rates now is that it's debatable whether it has any effect at all, because one thing banks are saying is we're trying to attract savers. We need people to make deposits here, and if interest rates are cut, then they don't have deposits to lend new mortgages. So although interest rate cuts may benefit a few people and tracker mortgages, it actually wouldn't necessarily help new funds, new loans, new mortgages come into the economy. So interest rates are very low, and the bank may well cut interest rates further, even to zero, but this cut from 1 to 0% would have only a limited impact on increasing spending. And the fundamental problem with the economy is that we did go through an asset bubble. We went through a period where saving ratios fell very low, and consumer spending financed by debt and borrowing increased. And with falling asset prices and a credit crunch, there really needs to be an adjustment. And there's only so much you can do to make that readjustment less painful. It's rather like the analogy of if you drink 10 pints of beer in the evening, you're going to have some kind of hangover the next morning. You can take a few pills to deaden the pain, but if you drink 10 pints of beer, you're going to have to expect some kind of hangover the next day. And it's the same with the asset bubble and bust. When house prices are falling by this rate, when banks have lost so much money, it's going to be a very powerful negative effect on the economy, and the government can try to minimise the decrease in aggregate demand, and it's important that they do, because without this intervention, the recession will be a lot worse, a lot deeper. But there's an element of just having to be accepting the fact that there needs to be an adjustment, and we can't have an immediate recovery, whatever we do. The last policy that we may consider is quantitative easing, and really this is to tackle the threat of deflation. If the velocity of circulation falls so rapidly that we start to experience deflation, I think it's important to avoid deflation, because deflation is very damaging. But it's a tricky business, quantitative easing, because if you get it wrong, you cause inflation. If you get it wrong, you cause deflation. So it's kind of uncharted territory, but I do think that the monetary authorities need to avoid deflation, because that can be very damaging as well.